Welcome to my channel. Please like, comment, and subscribe. How reserve requirements work. Reserve requirements are one of the most important features of modern central bank. We hear about reserve requirements almost every day in the media. When central bank like the Fed changes this requirement, it is said to have a huge impact on the markets. Liquidity worth billions of dollars is said to be either released or sucked out from the system. But do we really know how reserve requirements work? What are reserve requirements? The modern banking system is a fractional reserve banking system. This means that when the bank receives deposits, it's only required to maintain a certain percentage of these deposits in the form of cash on hand. The rest can be utilized to make loans. Therefore, if the banks keep too much cash on hand, they are simply losing out on additional interest that could be earned by lending out that money. On the other hand, if they lend out too much and keep too little as reserve, there might be a possibility of bank run and immediate insolvency of the bank. Earlier, the decision regarding how much to hold in reserve was taken by the banks themselves. However, many of them were not good at estimating that reserve requirement and end up landing in trouble. In order to mitigate this problem, the central bank have started prescribing the required reserve requirements. It is now the legal responsibility of commercial banks to maintain the reserve requirements as prescribed by their central bank. Another important point that needs to be noted is that reserve requirements are usually applicable only to demand deposits or money in saving accounts, negotiable or order of withdrawal, and OW accounts, current account, etc. In most countries around the world, reserve requirements are not applicable to time deposits. For example, money that is loaned out to the banks for a fixed period of time. Reserve as tools of monetary policy. Reserve requirements are remnants of an era gone by. The primary reason why reserve were required to be held was to prevent bank runs from happening. However, in the modern banking system, the Fed provides unlimited liquidity to its member bank in the event of bank run. Thus, the bank have no real need to hold reserves since their solvency is guaranteed by the Fed. In the modern time, reserve requirements have become more of a tool of monetary policy. This means that the central bank uses it to increase and decrease the amount of money supply in the system and therefore influence inflation. When central bank increase reserve requirements, the speed of credit creation is slowed down and liquidity is sucked out of the system. When they lower the reserve requirements, the opposite happens. The purpose of which reserve requirements were had has undergone a drastic change. It is no longer a safety net against bank runs. The next is viewing reserve requirement as a tax. Many opponents of the reserve requirements policy have also viewed the regulation as an implicit tax that is imposed on the commercial banks by the central bank. This is because the central bank holds a certain percentage of their funds without paying any interest. The amount of the interest lost as a result of this activity can therefore be viewed as a tax that has been imposed on the depository institution by the central bank. The central bank across the world have never mentioned any intent to abolish the reserve requirements concept, despite heated debates about the legitimacy of the same. They have, however, considered some proposal to modify the reserve requirements. They are as follows. Graduated reserve requirements. There is a bank that accepts more deposits from customers are typically at a larger risk of facing a bank run than smaller banks. As a result, some critics believe that central bank must create a reserve requirement structure which graduates with the quantum of the bank's deposit rather than having the same rates applied to everyone. Thus, a graduated reserve requirement ratio means that a certain percentage of the deposit will have to be held until a certain threshold is reached, and then the percentage applicable becomes higher. And then locked reserve requirements. Locked reserve requirements were basically suggested to make it easier for the banks to calculate and manage their reserve requirements. At the moment, the reserve requirements are based on the current amount of deposit that a bank has. Since calculating the current deposits are a dynamically changing number is difficult, managing reserve requirements also become difficult. The large reserve requirement system suggests that the current week's reserve requirements be calculated on the basis of deposits that were held 2 weeks earlier. And then evaluation of reserve requirements. Commercial banks have been averse to reserve requirements ever since the regulation was created. They view unnecessary block of capital without any compensation. I think that's all the information that I can share to you. I hope this can help you. Don't forget to give like, comment, and subscribe.